the government basically wanted to stop you from purchasing your home.
But first, let's hit it. Hi, this is Alan Victoria. Welcome to our channel.
And if this is your first time in our channel and you wanted to know everything about Greenville, Winterville, Pitt County, all the way to Raleigh, please subscribe in our channel. Also get notified when we put a new video for you.
Honestly, we get calls, texts, and emails all the time from people like you looking to buy, upsell, downsize, relocate, buy a different house, just kind of move to their first home. We love helping everybody. This is our cell phone number. Please don't be afraid of calling us because we're here for you and we know our market very well here in the Greenville area. So now let's hit it. No, let's talk about
Yes, we had a different video plan, but now when we got the federal update, we saw that is the best that we start giving you an update about the housing market and the interest rate by the Federal Reserve.
And like I said, I used to be an econ teacher, so when I hear econ stuff, I go woohoo, but most people are like, what does that mean? And I get it. So
therefore, let's hit it. Well, basically what was happened in June 15 by Federal Open Market Committee,
the FOMC, yes.
They decided to raise the interest rate or the fund rate 75 basis points or 75 BPS. That's what they call them. Which that was unprecedented since November 1994, no?
Yes, so we are talking the mid-90s is when the interest rates went up that fast. Again, the biggest rate. And this is on top of the Fed already going up 50 points and last time with the biggest hike since 2000 in May. So the Fed is tackling inflation hard.
Therefore, after the inflation report of the May and chaotic market, there was an expectation for this, but we didn't expect that we have 75 points. Basically, what the Fed trying to do?
Okay, so the Fed has blunt tools. Like they're going to take a sledgehammer to the economy. Basically, they have three things that the Fed can do to fight inflation. They're going to sell bonds. They're going to increase the interest rates, and they're going to increase the Fed fund the bank-to-bank loan rate. So in this situation, we're talking about the bank-to-bank loan rate, I believe.
Exactly.
But this also affects our interest rates and selling of bonds. So they found themselves dealing with inflation. Inflation is just a real thing. My gas prices are out of control. And this is going to affect our housing and the stock market as well. So we're going to mention those things at the end. So they're afraid that if they do nothing, they're going to disappoint us because it just looks like, oh, the government's doing nothing. So
this is the scenario one.
So they said, but if they go too high, then they risk forcing us into a recession. And then there's no jobs, and then nobody's making any money. So those gas prices on top of no job would just make everything even worse. So now they have to balance this out. You want to jump in?
Therefore, now look at the outlook for the GDP.
Gross domestic product.
Gross domestic product. That the government basically predicted to be 2.8 according to forecast for the month of June, or let's say the May that we have the data, but now we are down to 1.7 instead.
Now also just know 2.8 is still not a great economy growing, just so we're clear. Healthy economies grow at pi. I know that's a crazy math number I'm throwing at you.
3.14.
3.14, right? So if we are under 2.8 and now they've gone to 1.7, yes, there's still growth.
This is half a pi, basically.
We're not looking at pi, which is what we need when we're looking at for healthy GDP. So just so we're clear, GDP is not healthy there. At least according to me, econ teacher.
Therefore, according to what it happens, the central bank made it clear that the monetary policy tightening won't end till the prices is under the control. That means the inflation is not going to disappear right away. It's going to take a while.
And there's some great other people talking about what the causes of those gas prices increasing, but gas prices going up also increases how much our food costs. And this is why now people are buying generic and we're all having sticker shock when we go gas up our cars. So let's look at the CPI.
The CPI is basically Consumer Price Index. Therefore, if you look at the data from the February to the March, we have a slowdown a little bit. Slightly, we went down.
That's great.
And then year over and year in April showed a slight again decline that made everybody happy, you know?
Right.
And then what happens all of a sudden? In May, the number went super hot to 8.6%, which is the highest gain of inflation since 1981. Means 41 years ago.
Which is crazy, and blaming it on foreign wars and everything else is just one factor of it. The fact that there's other factors involved there too as well. But let's move on without getting into politics.
Therefore, economists basically introduce another indicator that exists but is not the center of the attention, which is PPI, or Producer Price Index. No? Therefore, when they wanted to evaluate, they said, let's look at this number. And turn out the annual PPI in May just was up to 10.8%. That almost was close in the history an all-time high.
Right, so now we're going to go a little bit into history, because I'm going to say a name I haven't said in forever. So in 1994, when I was very young, Alan Greenspan was the Federal Reserve Chair, and he raised it 7 times in 1994 to cool off inflation in 13 months. So he went from 3 to 6%. So there is some history. So let's hope history with the 90s is okay, because 90s had unprecedented growth and everything was okay.
It was okay, yeah.
Right, but so let's hope that is the plan that the government is hoping to get on. But I mean, let's not go to the 80s or the 70s.
Therefore,
who knows?
Before this 75 points that was for the June 15, the FOMC, or Federal Open Market Committee, it predicted that the interest rate is going to go 5 BPS or basis points in June, July, and September at least. Therefore, now we are looking at, we already happened 75 in June. Now we have July 25th, and also in the September, the next 2 meetings.
And the federal governor, Christopher Waller, has said 50 points, another 50 points is not off the table. Until inflation has come down to a target of 2%, they are not taking more of these interest rates off the table, which is going to directly affect you when you're trying to buy a home with us or anybody else.
Therefore, according to those data, basically the economists, they predicted that this inflation, by this policy, the monetary tightening policy, is going to reach to 4% by mid-2023, which is a year from now.
Crazy, huh?
Yes, crazy.
Okay, so now let's just talk about
the borrowers,
cost, which are you when you're trying to buy a house. So this is where it comes into play for you. It rose to above 6. If you were going to buy a house and you're looking to get in, your house has to come with an interest rate. We're not giving houses with 0%, not with all of this stuff. So we have now seen interest rates are now at 6%. They're predicted to be 7% by next month, which is even crazier. And this is, again, we're here in June. Just on January 2022, we were looking at 3%. So this is already the highest levels since 2008, before the crisis that we had in 2008. And
2 years Treasury yield jumped to 3.39%, highest level since 2007. And what happened to the economists, what they predicted?
Economists are predicting that the Fed will be forced to reduce that consumer spending, which means we lower our GDP by a lot. Which is also going to affect our wage gains and economic growth very much so. They're trying to tackle inflation and tackle it. To achieve their inflation goals, that means that they have to see the unemployment rate rise. So inflation and unemployment are on the seesaw. So that means that we're going to now see more people have no jobs as a result of trying to fight this inflation. And that is the danger for this economy.
Yeah, therefore, it's not all benefit. If we gain something, we're going to lose another thing. But let's hit to the what.
I thought you wanted to get to the Fed fund rate and it's shrinking the buyer pool.
Well, yes, exactly. It's gonna basically what happens is gonna do the poll of the buyers. But National Association of the Realtors, basically, in the recent articles that they published, they said the short-term Fed fund rate went 1.75 BPS or basis points.
So what?
But what affect that 175 affects 300 BPS, the mortgage interest rate. Means that, for example, if you're looking at January, which interest rate was around 3 or 3.1%, and you were looking buying a house for $300,000, your monthly payment would be $1,265.
But now?
But now
Same house.
the
same
same
price.
house, 300,000, with the new interest rate, which is at least 6.28%.
And going
Up, basically, you are looking at 1,800 per month.
And this is going to drive home sales down, not because people don't want homes, it's because they are driven out of buying a home. So this is the danger of this, is just people are going to rent, and then also rent is going up because of that inflation. So people are stuck in this rock and a hard place, and we don't have answers for that, which is really, really sad.
Exactly.
The pricing of the home is going to be critical for attracting buyers. So if you're
This is
selling
what
your
exactly National Association
when you're
Realtor.
selling your home, your real estate agent should definitely be aware of everything we're talking about, because it's going to, you need to make sure you're pricing it right to sell your home at the right
Exactly.
price. It can't be so crazy high. Will the market probably dictate some softening of what's going on, which is good for buyers but not necessarily good for sellers. So make sure when you're pricing it, it is on point, because if you price it too high, you've just lost the market and you're just going to sit there. And if you price it too low, you're not going to get your value either. So make sure everybody is aware of everything we're talking about when it comes to pricing your home as a seller.
And on top of that, the rental demands also is going to strengthen along with the rent increase. Therefore, we definitely expect to have a rent increase because of the market and the interest rate, and many of the buyers price out of the market.
All right. So, notably shifting in the demand market, Fannie Mae was predicting 30-year
That was
loan.
prediction before all this crazy
Right. They
happened.
were predicting that we would be at 3% by the end of 2022, or 3.3. Now they were predicting 4, which is still crazy because now we're in the 6s. So it tells you just their own predictions are just crap. I'm sorry, I don't like to swear, but it is. And future sellers have to price their houses according to what is happening in the market when you go to market.
Therefore, if you look at the rate in the interest rate in the month of May, we were 5.3%. Now with the new 75 point, with the fund rate, interest rate went up. Now we are looking at 6.28%. That means Fannie Mae and also Mortgage Banker Association, they were not basically accurate in their prediction.
Crystal balls aren't working.
Exactly.
So home buyers in 2021 with a 400K
Therefore, we're
loan.
going to give you another numbers that we're going to do it here for $400,000 loan.
Right, they were paying $1,708 at 3.1%, but in June 2022, same house, same price, $2,471. So this means that our home already appreciated $480K, which is also crazy as well. So that $400,000 home is now worth $480, which is again crazy.
And what is going to happen?
And it means if the same house with that appreciation factored in, you're now paying $2,695. $2,965, sorry.
Therefore, we're going to go from what it was, $1,708. That was the previous interest rate.
So basically, for what we're saying is $400,000, you're getting less house now for your dollar.
Exactly.
So
that was the message. And in overall, the CPI, that consumer price index, basically, even from December 2021 now in June, went from 7 to 8.6%. And you see this 1.6%, that's what happened.
So immediately what happened when this happened this week, the stock market, just as a indicator, not that it really matters for the day-to-day lives and people buying homes, but for stock market, what we have seen already, and when the Fed announced these kind of numbers, we are now in bear market territory. We went down 24% from the record high of January 3rd, which I know record highs and record lows aren't really accurate, because you want to kind of look for the middle road. But either way, we're just showing you that this has a direct effect on the markets, and it also directly affects you when you're trying to buy a home, or you're staying in your home. So when you're talking about buying your home or selling your home, make sure your agents are aware of able to talk about what you're going to pay, how much you're paying, how much you can afford for a house. So we really do try to stay on top of it. We don't try to push you into houses you can't afford, and we don't want to try to undersell you to something that you won't be happy in.
Exactly.
So we are just trying to help every single person that we can that comes across our path, and we're trying to help you get into these homes. And we hope this video was helpful, no?
Of course, I hope this video is helpful. We always wanted to update you, educate ourselves, to educate too.
Yeah.
And also stay tuned with our YouTube channel and
And if you want me to talk more about economics, I'd love talking econ. I know it's a hard topic for a lot of people. If you want more about it, just kind of hit us in the comments that you want us to talk about this more. I'd love to talk to you.
And looking forward to the next video, guys. Have a wonderful day and talk to you soon.
Bye.
Bye.